little bit of an outline in terms of the context. It's my little joke on the right-hand side. See if you can get it. This is what Theresa May eats for breakfast, given that it's a breakfast presentation. I think Mr. Macron is enjoying his champagne breakfast at the minute. But we'll come on to the politics at the very end, because it's obviously front of mind for a lot of investors, occupiers, real estate players. But a bit of global context, a bit of going into the cyclical and the structural impacts and trends that we're seeing shaping our markets, a little bit in terms of the outlook for different countries and different cities, and then, as I say, we'll come back to the politics, in serial metaphors or not. Okay, context. So, investment trends globally. This shows Asia-Pac, EMEA, and the Americas. So what we've seen, obviously, since end of 2015, 2016, EMEA's trending downwards. We're slowing down, but we're not jumping off a cliff as we did in 2007, 2008. The Americas are also seeing volumes trend down. Interestingly, Asia-Pac is now seeing volumes trending back up, but they went through their sort of peak much earlier, a couple of years ago, and it now looks like activity in that market is rebounding. And a lot of the capital that's going into that market is Chinese money, so it's actually a big growth in intraflows from China into the rest of Asia. What we're also seeing, interestingly, is actual yields in Asia moving down even further. So we're getting much lower points in terms of typical trading yields across the region. So even though there's a bit of a downturn in EMEA, yields are still moving further down. Interestingly, the Americas are starting to move back up. But this is not prime yields, this is trading yields. So this, I think, reflects the fact that some investment into the States now is moving suburban rather than being sort of very core or urban. So I think that's partly a reflection of that. It might also be a reflection of a movement in interest rates that are expected in the States this year. Again, so bigger global trends, what's driving this? Well, there isn't a dip because the amount of capital looking at real estate just continues to grow. It's doubled institutionally in the last 5 years, and there seems to be a limited end to the extent to which it will grow. The other side is alternatives, certainly when it comes to fixed income. Bonds have been going down for the last 30 years. They've started to move back up again, which has sort of relative importance to the real estate market. But even though they are moving back up, I won't try and explain this one in detail because it would take me all session. The forces that are driving interest rates down are basically much stronger than the forces that are pushing rates back up. So I think we're in definitely a period of lower for longer, and that's reflected in lower return expectations of a lot of the big players, and that will continue. So even though yields are moving down, I don't see that as a problem. I think that's going to continue. Globalization and technology will come onto structurally the two forces that will continue to keep them compressed. Demographics is also clearly very important. And I think we are certainly seeing the impact of changing demographics within this current investment cycle. Now, Europe as a whole, we've got basically a declining working population out to 2030 and minimal population change. But across Europe, you've got some pretty big differences. On the left-hand side, you've got Poland, Russia, Germany, quite significant declines in working population. UK, the Nordics, you've actually got growth in working population and growth in total population. So we've got a really quite diverse picture in Europe in terms of the population trends as they're forecast for the next 10, 12, 13 years to 2030. But then you get out of Europe and into other parts of EMEA, you've actually got much stronger working population growth, but you may not necessarily have the political regime to make the best of it, certainly in places like Turkey or South Africa of the minute. But we've got a really diverse demographic picture, and it's definitely starting to have an impact. To me, it's at the heart of a lot of the changes structurally that we're seeing influencing real estate, alongside technology, politics, changing legislation. It's changing the way we live, work, and play. That's changing market forces and changing how we use real estate. Cyclically, we've got things looking much better for Europe, so we've got positive growth coming into the Eurozone now, just as the UK has decided to leave. The UK is still growing, but if you look at all the GDP forecasts for major markets across Europe this year, they're all trending up, so the cyclical picture is very strong. But when it comes to the occupier conditions across markets, we've got a really mixed picture, and I think this is the confluence of the cyclical growth, but also these structural changes that are having an impact. Yellow is tenant favourable markets, red is landlord favourable markets, blue is neutral markets. So for an occupier, it's neither in favour of a landlord or tenant. So this is for offices, but still 50% of major office markets, locations in Europe, are still tenant-friendly, which is surprising this long into the cycle. You look at the logistics market, and it's completely different. It's much more landlord-favourable, far fewer tenant-favourable markets. And I think this is the impact of e-commerce in particular, and how that's changing the growth in industrial and logistics. Retail, it's a complete mixed bag. It really is. I mean, within core cities, I think it's very strong. Outside of that, it looks particularly challenging. So if you look at some of the other structural changes that are having an influence on office demand, so activity-based working is definitely one big change. I mean, as an organisation, we didn't have anybody working in workplace consulting 2-3 years ago. We've now got a strong group globally working in this space. And a lot of the guys who are working on the ground in Europe are interestingly saying a lot of the demand that's coming through, a lot of it is reconfiguration of space, where it's new space suited to activity-based working, but it's not necessarily representing a net increase in demand for space in markets. So there is net absorption in a lot of markets, but it's not the same as it used to be. This is changing it. AI, which is not me being a northerner, it's artificial intelligence. A lot of people we speak to think this is something that's going to be coming, but it's actually already having an impact. A pretty profound bit of evidence came from Goldman Sachs in an interview with MIT. The CEO said a third of their workforce is now computer engineers. It's guys that build algorithms. Their New York office had 600 equity traders in 2000. They've now got 2. They've got 200 IT engineers who are building algorithms, and those algorithms are creating algorithms to do all of their trading. So that's a pretty profound change in 15 years. And that will affect all sorts of businesses, all sorts of sectors going forward. The extent to which it does have an impact is going to be down to the regulators and how it's legislated. But that will reconfigure again how we use office space. Industrial logistics has gone through a huge amount of change in this last cycle. If we look at it globally, the global shipping world has been consolidated. There's been a couple of companies that went bust. Haijan went bust last year, and it's consolidating all the time. But what that means is, I think they're down to now 10 players at the beginning of this year. Well, beginning of this year, they had 10 major global shipping companies basically bossing global trade, how it comes in and around our markets. They're now down to 8, and I think that will continue to compress. Maersk, which is by far the biggest now, has got over 25% market share, is moving into the logistics space. Then you've got companies like Amazon and Alibaba that are moving the other way from the retail side and going back into that logistics and global shipping space. So it's been completely reintegrated, reshaped as an industry. And how these big companies will determine where goods come into countries, into regions, is going to determine the flow of goods across those regions for the foreseeable future. But when we get to cities, what we're also seeing is a big push towards green freight, green city freight, waterborne traffic, rail traffic, and increasingly electrified CO2-friendly freight. And that's going to be a big push and a big change that we'll see over the next 10 years. 50% of freight needs to be electrified by 2030. And a lot of cities are changing already. Cities like Paris are making some pretty big, significant changes to how they distribute. On the other side, obviously logistics is having a big impact on retail, Amazon in particular. I mean, the reason why Amazon is integrating its supply chain is to cut its bottom line. So all of these e-commerce players don't make a profit, or they make a tiny profit. Their margins are small. So what they need to do is figure out how they increase their profit. For Amazon, it's integrating its supply chain, and it's getting into the retail space. That's really hitting traditional retailers. 3,500 is the number of stores that have closed in the US so far this year for traditional retailers, so Sears, Macy's, your typical anchors. And I think the tricky balance as we go forwards is the extent to which retailers can balance e-commerce to drive growth and scale, but optimizing their footprint to drive profitability. Companies like Next appear to be doing it quite well, even though they're taking on more space, but they're actually taking it on at lower rates, and it enables them to drive profit and sales. But what will happen to the traditional anchor? It is definitely changing. A lot of new retail shopping centre schemes that are coming through don't have a traditional anchor. And then, of course, we've got virtual reality. So there is one shopping centre that has a virtual reality headsets as part of its anchor. But there's also an online mall, it's virtual reality mall, which is entirely online. So that's going to revolutionise digital shopping again. I think by the end of this year, you might well see, I have actually seen a prototype of phones and tablets which allow you to look at things 3D, on your screen. You don't need the glasses. So that's coming quicker than you might think. Again, experience economy. The Chinese demand for retail is bringing European retailers into China, but it's also impacting our tourism. And it's just one of many factors where there's more tourists coming across to more cities, and how they want to experience those cities is also changing. That's driving companies like Airbnb, but also companies like Zoku, which are tapping into these kind of global nomads. Companies like the Student Hotel, definitely having an influence on the hotel business. Upscale luxury is growing in terms of investment into the sector, but also the budget experience part is also growing. Anybody in the middle? Looks like they've got a real challenge ahead in the next decade. And then the other part is how this is blending in with residential. Now, we know student housing is a big growth area and has been for the last 10, 15 years. But if you think about the demographics, that's got to start diminishing at some point. Yeah? It's only natural if there are less young people moving through and obviously going to universities. Clearly the big market is senior living. So there's 20,000 baby boomers retiring every day as a conservative figure in Europe. So if they've got 50 grand's worth of equity each, that's $1 billion a day. $1 billion a day. It's a lot of money. That's a big opportunity, and we are seeing more players trying to engage in this sector, and it's clear why they're doing it. Put all that together, look at this over the last cycle, and I think what's interesting to see within major cities across Europe, which represent the lion's share of investment activity, office investment is down. Retail is actually strong. It's actually grown a little bit. Resi is by far the biggest beneficiary of these changes, as is hotels. Industrial hasn't really changed, but I think that's because we're yet to really see urban logistics kick into major cities across Europe. And I think this trend will continue over the next investment cycle. Where's the money going to go? Well, if we look at where investment capital's gone, last year on the left, what was quite interesting to see was Germany pipped the UK for the first time ever. Just really marginal, decimal points, but the Germans like the decimal points. 10-year average, obviously the UK is much stronger, but will this change? How's it going to look over the next 5-10 years, given all the political changes that we've got? There's an absolute score that we give countries. So this is some work that we put together at the end of last year, which looks at political risk, all of the economic growth factors, the demographic growth factors, lots of other factors that are influencing real estate, to give each country a score in terms of their outlook for the year ahead. And what was interesting was Germany actually pipped the UK to the #1 spot, but you still got the main tier 1 markets right at the top. Then you got the Nordics, the Dutch, before you start moving down to the peripheral markets, which is kind of what you'd expect. But maybe a bit surprising that you'd have Germany first. But if we look at Q1 investment results so far this year, Germany is clearly far ahead, far ahead of the UK, but the UK is still a very, very strong second. France is not showing up as much as it could, but maybe Mr. Macron will be a big changer in that regard as we move forward. Interestingly, Spain is #3. Obviously, big, strong economy so far this year, a lot of opportunity, a lot of potential. And when you look at the volume of latent talent within major cities across Europe, so this is the number of people that are unemployed, but with skills, so they're highly employable. Paris has got by far the biggest latent potential. So this is potentially the latent demand to drive office demand, which will obviously drive investment demand. But Madrid and Barcelona are #2 and 3, so maybe there's a logic to this investment going into Spain. Maybe it's trying to tap into this latent potential, which is driven by very high levels of youth unemployment. They're not the only factors that you need to consider as an occupier when you're trying to grow and drive a business. So the one thing that knocks the Spanish cities back is their English language proficiency. Out of the 20 markets that we looked at, Madrid was lowest. Only about 27% of people in Spain have got strong enough English language proficiency. Barcelona wasn't far off that. Stockholm, on the other hand, which is #5, is much higher up, as you kind of expect, is about 90%. But when we put these city scores together for these individual cities, a lot of other factors were brought in. So it's the economic output, workforce composition, how suited a city and its workforce is to a modern digital economy, the cost of being there to an occupier, the cost and affordability of living, the ability to save, and obviously, with things going on at the minute, country risk and labour market flexibility. So you put all those factors together for those cities, and actually London comes out as the number one city, certainly in this analysis that we did last year. Then you got Paris, then you got Manchester, Stockholm, Dublin. Spanish cities are somewhere in the middle, but actually those mid-ranking cities are very, very closely scored in terms of their attractiveness to office occupiers. But if you think that office investment is still the major part of investment into cities, and this is what attracts occupiers attract investment, so investment should still follow where these occupiers are looking. Now, there's a lot of question marks clearly over London in terms of Brexit. This is the number of jobs that have been declared they're going to move so far. It's less than 7,000 at the minute. The cities of choice are Dublin and Frankfurt. Frankfurt is driven by its very strong regulation, first and foremost, for a lot of financial institutions. It's not necessarily driven by talent. Dublin is also its regulatory side, but also its experience for other players within this field working established within that market. But the idea that there's going to be a huge exodus of jobs from London into other European cities is clearly not happening yet. And all that appears to be happening is contingency planning at the minute. There's still no actual, genuine, full movement. It's still only 7,000 jobs are being reported to go. So London is still very, very strong as an occupying market for FPS because it's got all of the infrastructure and it's got the talent. And it's just interesting to look at, given the very low unemployment levels that we have across Europe, just what a kind of dearth of fresh talent we've got in many of these major cities. So this is the size of the financial business services pool in dark. Light blue represents the total skilled talent pool of these cities. So again, Barcelona scores highly, Berlin's up there, Stockholm, but London and Paris have got by far ahead the most talent to continue to attract occupiers and continue to attract capital. Of course, politics can change all of that. The election that we had last week has just generated more uncertainty, even though leading up to that election, there was a shift in consensus within Britain towards people moving from remaining to deciding to relieve, just wanting to get on with it, and ideally wanting to see a clear Brexit. I think the UK position has clearly been weakened by what's happened. We still don't know whether we're going to get a hung parliament or what kind of parliament we're going to get, whether we're going to get another election. We may survive. There's just a lot more uncertainty when it was meant to be a lot clearer by now, even though there is this consensus that's supporting Brexit. But there's a lot of interesting players out there within the political landscape globally. We were in Barcelona last week for our conference. And as you'll probably recognise, Pep Guardiola is not really a politician. He's the coach of Manchester City, but he's fronting the Catalan referendum campaign for independence against Spain, and they're going to try and push that through. So, a bit of a joke, he's not a politician, but just interesting just how diversified Europe's politics really is, and it's not just the UK that's suffering. France is looking a lot better clearly. I think Germany is still strong, but there's still an awful lot of movement within this space, and it's going to be with us for a long time to come. If we look at the major political events to watch, obviously we still don't know the result of the UK election. But we've got, there's still a Greek debt that needs to be repaid by the IMF. That's still to be decided. We've got the German elections coming up. We might see another Italian snap election. Will we see another UK general election? Will there be a Spanish referendum? I think it's going to be well late into Q4 this year before we have much more clarity as to how this whole thing is going to pan out and how this is going to really impact Brexit. Between now and then, all bets are off in terms of how the politics is going to shape up. That tops the agenda, but coming back to the investment side, despite some end-of-challenge weaknesses within real estate investment, all the long-term trends are really strong, and they're completely reshaping what investment is going to be a good bet as we sort of move forward into the next cycle. It's still very attractive as an asset class to investors, despite low yields, because we're in a much lower yielding environment anyway, and a much lower return environment. For me, the disruptive defensive qualities of industrial logistics and residential are probably my top two that I'd be looking at most strongly. But I think the tier one countries and the key cities are clearly going to continue to dominate investment as we move forward, because primarily they've got the talent, the infrastructure to attract the jobs, which then drives investment. And that's it.